morning, good afternoon. Welcome to Risky Business, and this is our first global edition. So we have people joining from all over the world. So I'm really proud of that one, and thank you again for joining. I'm in Europe currently, and it's 1 a.m. for me, which means two things: the market never sleeps, and apparently neither do I. So, so today is about having a global energy roundtable. The goal is basically to discuss how markets did move so far this year, and what could further define 2026.
Hi, everyone. Nice to be here. It is 7 o'clock p.m. here in West Virginia, United States. I help our Trio clients manage some of the risk in their portfolios and develop strategies, do a lot of market intelligence, which is why I'm on this call. Glad to be here, excited about what is going on around the world. I'm interested to hear what Jeremy and Derek have to say, but thanks for inviting me, Sanjin.
Thanks, Jeff. Jeremy, if we can go with you next.
Good morning, good afternoon. It's 7 a.m. in the morning here in Bangkok. We work in the Asia market, work in market intelligence and outsource energy management services for clients. And I think we can best describe the Asia market at the moment as one in transition and an evolving market at the moment.
Thanks, Jeremy. And Derek?
I'm here in Sydney, and it's 11. It's 11:15 in the morning here, our Tuesday time. So we're furthest into the day. The sun rises across Australia, and then moves across Asia, then Europe, and then the US. So between the four of us, we have a very, very long day, and there's a lot going on here in Australia. I run Energy Action, which is a partner with Trio, covering off the Australian operations of our multinational clients.
And how would you describe your market currently?
It's an interesting time. Well, electricity markets are always interesting, but what's going on here in Australia is everyone is very thoughtful about AI data centers and how they are going to be very, very large consumers of electricity, and how they're going to source all of that, and how that's going to impact electricity markets and prices. Batteries is the second main trend at the moment. Probably be repeating these messages as we go through each of the regions of the world. But there's an oversupply of electricity. There are negative prices. And battery costs are becoming cheaper and cheaper with the Chinese oversupply. So as a result, everybody is thinking about how batteries can get electricity costs down. And there's a lot of talk about all electricity consumer sites having batteries over the next several years.
To describe our markets over here, I would say they are robust to some extent, but very jumpy on any change that might happening. Okay, thank you all for kicking us off. The question basically, what I'm keen to learn from you, maybe to start off now with Jeremy, for your market is what I would like to know is what's the marginal driver basically. So what's moving prices in your region? What is it, and what are the main factors?
Traditionally, Asia has been low prices. I mean, we exclude obviously Singapore in that context, but certainly you look at most of the Asian market, it's been low prices. Historically, the governments have obviously heavily regulated market, and prices have been subsidized, and also to benefit from good natural resources. So there's good abundance of coal and gas. So that's the history what's kept prices quite suppressed in this region. Most analysts sort of would say that Europe, Asia Pacific is going to account for about 80% of the power demand growth going through the next 5 years, driven by AI, data centers, electrification, obviously decarbonization driving mass as well. So the issue for pricing is how do you actually move forward, because you need to obviously invest in grid infrastructure to accommodate new renewable energy, and obviously the increasing demand is going to drive up the prices as well. So I think what we're going to see in Asia is higher prices. I think we'll see the governments trying to contain those prices as much as possible, because obviously they don't want to industrial prices to go up to impact economic growth. But I think we're going to see higher prices in Asia going through the last sort of few years of this decade.
Thank you. What about you, Derek? What is basically mainly driving your prices currently? What are the main factors and why?
AI data centers is on the horizon, but it hasn't really impacted the forward curve here, which is a bit unusual. In fact, forward prices have actually fallen over the last several weeks, and the trigger for that was one of our large coal-fired generators, which was due to be closed down, has now been extended, and the reason for that is this concern about huge demand for electricity coming from these data centers. So there are several other coal-fired generators that are planned to close over the next couple of years. But all of a sudden people are asking, well hold on, how are we going to transition from coal-fired electricity to renewable electricity, while in addition potentially meeting a huge new demand for electricity from data centers? So the markets have come off over several weeks. However, there is this big upside price risk looming. A lot of our clients are currently working out how they can lock away these current prices, these current lower prices, given this upside price risk overhanging the market.
Thank you, Derek. And Jeff, apart from the US being exceptionally cold in the latest weeks, what else is driving your market?
If I had to try to sum it up, generally speaking, it's the globalization of the U.S. natural gas markets. So in 2015, we were a net importer of LNG, and we are now, December, close to 20 BCF a day of exports of liquefied natural gas. So as that surplus used to be a supply push market, we had more supply than what we knew what to do with. We didn't have enough demand. It's becoming a demand pull market. So demand from Asia, demand from Europe, demand from domestic power, data centers and power demand, all pulling on that supply. So now it's shifting from that supply surplus to really a supply going to be a deficit, and we're seeing that in our prices here as the cold dimension pass through. But it's a variety of things, and it all boils down to that globalization. So when we talk about natural gas policy, energy policy in the United States, geopolitics around the world, weather, all of that's playing a role in kind of the drivers of the U.S. markets, and particularly, policy. With the administration change a year ago, subsidies for renewables going away quicker. I think Derek mentioned extending coal-fired power plants. There's about a dozen that got extended in the U.S. here in the last several months. They're just not letting them shut down due to the fear that demand is going to outstrip the supply of energy. So there's all kinds of variables that we haven't seen in the U.S. market really ever, that's playing a role in kind of how we see it going forward.
Yeah, just to add also from European perspective to accomplish the picture is our marginal driver is a triangle currently between LNG, weather and storage. And just to your point, Jeff, LNG sets the supply tone for our market as well. It's weather that drives the short-term demand, and then storage tells us how nervous the market really is. So, and when all three line up, everything is well. And when they don't, then volatility comes back quite quickly, as it is, I guess, similar in your markets as well. Maybe, Jeff, while I have you, and you already mentioned it, for you, is there any other, let's say, cross-border link to your region besides LNG?
Yes, and it includes LNG to our neighbor to the north, Canada, who are just now getting into the LNG export business. Of course, their regional advantage is to take LNG off their west coast to Asia markets. Mexico getting into the LNG export, surprisingly, they're short. They import a lot of natural gas from the U.S. There is their first Altamira export facility on their east coast, and just in January. Never seen it happen before. U.S. pipeline exports to that Altamira facility. They liquefy it, ship it up to eastern Canada, gasify it again, and import it via pipeline to our northeast markets in the U.S. back again. So it made a full circle. Maybe not the same molecules, but it made an export of physical gas via pipe into LNG, traveled up around the east coast to Canada, imported into the east coast of Canada, then re-imported back into the U.S. via pipeline into the northeast market that's physically short. So LNG in various ways that we haven't ever seen happen before, being seen right now in this market.
And coming back to that, Europe is structurally dependent on LNG after the loss of pipeline gas. So, and the US is the supply source, but on the other end, also LNG links Europe directly to Asia because there is a demand competition. So maybe back to you, Jeremy, then maybe you can talk about that and basically the cross-border links from the Asian markets to the regions that we have today on the call.
Keeping on the LNG front, yes, I mean, demand for LNG in Asia is growing because we need to displace coal, and gas is the fuel that basically bridges the intermittent renewable generation. So clearly, yes, LNG is growing. Strong growth. We expect strong growth this year in China, in India, Vietnam, Philippines, Thailand, pretty much across the area. Although, of course, a lot of the growth that China is still expected to take the sanctioned LNG from Russia. Won't impact the market too much, but certainly energy growth is growing. In terms of integration, what's interesting in Asia at the moment is, I don't know if you guys remember, but years back there was talk of an Asian power grid whereby the 10 Asian countries would all link together and link their power grids, almost like mimicking what's happened in Europe with integration. What would actually in the last couple of years there was the power integration between Laos, Thailand, Malaysia, and Singapore, whereby renewable power that's generated in abundance in Laos is wheeled through Thailand and Malaysia and into Singapore, which is obviously short on electricity, short renewable energy. Well, this is a small project that's only about 100, 200 megawatts. It's going to build up in capacity. But what it actually does is it prefaces the potential for a regional power grid. And I think if Asia is going to develop as a market, it needs to share resources, and it needs to do that. You need to do what has happened in Europe, where you've had a more integrated market. So I think that is a positive development. But I still think politically and regulation-wise, it's a long way off. And I think from an integration perspective, that's important. If Asia is going to become a more sort of efficient resource base going forward.
Thank you, Jeremy. And Derek, for you, because Australia is obviously has some ground rules on its own. So, but I would really like to learn maybe from your end, what does connect you to other regions the most?
Well, we're still trying to connect ourselves up. Looking at the maps behind us, I think West Europe actually fits into the territory covered by Australia. Also, we have Tasmania down to my left, we'll see, which is connected up to the mainland. But we have, on our east coast, we have the New South Wales market. To our north, we have Queensland, and to the south, we have Victoria. Then we have South Australia and West Australia. So the eastern coast markets are all connected up. Quite often, the grids, the transmission lines between the states become constrained. So it's a mixture of an interconnected market at times where we all share the same wholesale price, but half the time the transmission lines are constrained, at which time we have different market prices. So we're laying down more and more wires to improve the connection capacity. So it's a little bit like Europe. Europe operates on a similar principle, and in the North American markets probably similar too. So in Australia, we have fantastic plans to move away from coal-fired electricity towards renewable electricity, and we also have some gas. Now most of our gas is being exported, and there's a gas reservation policy requiring gas producers to save some gas for local gas-fired electricity generation purposes. There are quite ambitious plans to completely move off the coal-fired generators to renewable electricity. So huge solar and wind resources across Australia. The biggest cost is actually building the transmission network out to the wilderness areas, the vast wilderness areas. But unfortunately, as Jeff was saying, concerns over increasing demand for electricity for data centers. We're now wondering whether we're able to close down these coal-fired generators as planned. So we're still trying to do the energy transition, but we're also trying to meet the energy expansion. We have the right intentions, but the energy transition has been slowed down by this new demand for electricity from data centers.
Just coming back a bit, I think, what we're talking about a global market here. Quite clearly, what links all four regions is LNG. I mean,
absolutely.
Physically, there's a link between America and Europe. There's a link physically between Australia and America and Asia. But more importantly, there's a financial link between Europe and Asia, because the European market is totally dependent on the JKM TTF spread. So there's an interesting sort of balance. That LNG is going to drive the market forward globally. We all expect new projects to come on stream and to increase supply. There is obviously some discourse as to whether, in fact, AI and data center growth is actually going to eat up most of that surplus, and the market might be tighter than we perhaps thought it was in the second half of this decade. But energy is the mover, and certainly with respect to Europe and Asia, it's the competition for those spot cargoes driven by the arbitrage. So there's a leak in the market there.
And you're absolutely right. So and it's not, as I said, obviously, US is the supply source for Europe, but Asia is the competition for that. And those cargo ships and those cargo flows, they're quite flexible and they move to the highest bidder. So the transmission in those prices is quite fast. So, and that's something we also reckon, depending on the price movements and depending on where those cargo flows, that can be quite flexible, and then it does disrupt markets all over the globe. So, and you're rightfully saying, I think that's currently a one big, strong connection point.
Let me throw in a statistic about that international play in the financial markets. In 2021, natural gas options trading of the Henry Hub, our benchmark here in the US, by European and Asian counterparties represented 1%. So the options trading of the Henry Hub contract. In 2026, January, that percentage had increased from 1% to 16%. So 5 years, big increase. If we talk about the actual futures contracts themselves, the number, the volume, and the percentage being traded in 2021 by Asian and European entities went from 9% in 2021 now to 19%. So many more players, whether that's equity investors or trading partners, much more influence that have ties and are referencing, in many cases, the Henry Hub, our benchmark here, that's influencing the price here because they have to protect that price. So they're engaging more in options and futures contracts that are impacting the domestic price here in the U.S. from entities that are outside of the U.S. in Asia and Europe.
And a similar thing has happened in Europe. Obviously, positions taken by hedge funds in the TTF market, especially long positions, have increased during the years because it has been a much more volatile market. It has been obviously driven by geopolitical events, supply chains, and basically hedge funds are opening those long positions, so they also want to let's say bet on market trends and price movements, and they are becoming really a fundamental factor when we are looking and trying to forecast the market going forward. So similar as at your end, Jeff, as well. To move towards the next phase, so if you can maybe name for each of your reason a price factor or risk that's currently underpriced in your markets.
Yeah, we think that the upside price risk around data centers has not been priced into the forward curve yet.
The issue we're going to have here is going to be non-commodity costs. I think traditionally we haven't actually broken those out of prices. Malaysia has started to do that. But I think that the problem we're going to face in Asia is that there is insufficient grid capacity to basically incorporate the new renewable capacity that's being brought on. And that cost, I don't think, has been reflected in prices at the moment. I think that's going to have a major impact. And how the regulated markets address that, I don't know. Would it be passed through in general taxation? Will they put it through in tariffs? But that's going to be a big issue going forward in Asia to try and accommodate the cost of investment in the infrastructure.
I'm going to go with probably the speed and the, I guess, slope at which renewables will be invested in the U.S. in the future. With the current administration, it's going to, the future of that is unknown for the next at least 2 years. We'll see what the elections do this fall with the Senate, and who takes control of the House. But the speed at which, and I'm going to call them intermittent renewables, so without battery backup, at which they can take over more of the U.S. market, and the impact that will have as the stable 24/7 data center growth, how fast that comes up. We're going to have more reliable energy in the U.S. to meet that demand. So the speed at which renewables can come online to match the speed at which demand centers will come online.
I agree with you on that one. It's similar for Europe, but I'm not going to go into country by country because the legislature is quite different depending on where you go. But from a continental point of view, the thing I'm really being a bit, let's say, what I still see risky is that any LNG logistics or infrastructure disruption during, for example, peak winter, demand is still a scenario where prices would skyrocket in Europe, and that is very well underpriced, and I'm personally not hoping that this event will occur in the next weeks.
Well, we saw that in the U.S. prices with Winter Storm Fern from that week or week and a half of cold weather. I put it on a chart a couple weeks ago whenever I saw it happen. It's literally, prices went up at the Henry Hub, spot prices, so they could take that gas and physically sell it in the market for the next day. We saw a very correlated drop in LNG feed gas that goes to those export facilities. And as soon as the price came off those highs, LNG export feed gas started back in. They just opposed each other, really inversely correlated, and almost to the hour of when those prices changed. So very interesting. And your prices I saw in Europe, TTF, NBP, actually did the same thing ours did, but in much more, again, historically much higher volatility.
Exactly. And maybe to close it up, to go into our last question is, so if you could tell me what moved 26 so far and what could potentially bite us next during this year?
One of the interesting markets, I think, in Asia at the moment is Indonesia. Indonesia is traditionally a long LNG, but the problem in Indonesia has is the growth demand is outstripping its energy, and it's probably going to become an import of energy this year. The other factor on LNG, a factor on Indonesia is coal, and it's trying to keep the coal price up by reducing production, which has actually caused miners to basically down tools, which is coal prices up. I think the past week the Newcastle price went up, certainly in Australia. So I think in a nutshell, it comes down to supply and demand and how you're actually managing the price going forward. I mean, Indonesia is an example of that. China is an example of that as well. So I think what's going to be a factor in the market this year is how supply demand is managed, and how that impacts prices going forward.
Yeah, I think there are three drivers of price risk this year. So I mentioned on the demand side we have the data centers and how that may impact the curve. On the supply side, we have batteries. Batteries is the big mover this year. Government's brought in a big subsidy. Cost of batteries is coming down with oversupply from China, and we have a huge amount of excess solar producing negative prices during the day. So batteries are really moving this year here in Australia. And then the third point is the coal-fired generators. There are some old ones that we've run down. They haven't been maintained. They're due to close. But I think regulators are starting to think about whether we are going to need to somehow prop them up to extend their lives to meet this potential demand increase in demand. So coal-fired generators, batteries, and data centers will be driving prices here in Australia this year.
Talked a lot about variables that no single region or continent controls. I'm gonna go back to one that's always been here, but no one really can predict, and that is weather. Weather has hit the U.S. Just last month harder than it's hit in many years. And we're seeing now that we're globalized with LNG exports, how that impacts current market here in the U.S., neighbors to the north and south, and even in Europe and Asia. So I'm going to go with weather as the variable that is going to impact our prices potentially the most. That all equals lots of volatility. And volatility can be in both high price markets and low price markets. There will be, I think, opportunities no matter what happens, but there's going to be a lot of risk involved with volatility as a result of weather.
Thank you. And maybe just to add, in a similar perspective for Europe, typically Europe is fine until it isn't. so then when it isn't, it does reprice quite fast. So I think the risk in Europe currently is basically maybe a stress event. So a cold spell, low wind, or an LNG disruption could really hurt the market badly. Also, what we are currently following quite closely is gas storage levels, which I think are just around 27% this week, which is quite low. And this is something that we will be tracking going forward. Weather forecast for Europe switched on the milder end, and that's why this Monday when we got up, we had a I think minus of 7% in the morning. So with the reforecast of the weather, so it's currently a key factor in the short term, and it's a main switch. So in Europe, because we are now dependent on not anymore on pipeline gas, but on LNG supply. So, and this does change the picture completely. And having said that, I think we came to an end. I want to again thank you all for participating. This was super insightful for me. It was really a pleasure and honor to talk to.
Thank you.
Thanks for organizing.
Thank you all.